Hello everyone and welcome to our most recent webinar on the Academy Trust Handbook and the Academy's Accounts Direction. Can't quite believe a year has gone by and we're almost into Academy season again. Quite scary. To introduce myself, my name's Darren O'Connor. I am one of the partners here at James Cooper Creston and I also head up our Academy's sector and division. I'm pleased to be joined also by Becky Foy, one of our managers, who also has a great deal of experience and knowledge in the Academy sector. A bit of housekeeping before we start. Any questions that you may want to raise, please raise it in the Q&A box and we'll do our best to answer as many as we can. Don't worry, if we don't get to you, we will make sure that we come back to you shortly after the webinar today. So first of all, moving to the Trust Handbook. You'll be pleased to know, so I can just move on to the next slide. I think you'll be pleased to know that there's not too many changes this year. So let's just start with an introduction of what the Trust Handbook is for. It's been around pretty much since the Academy the Academy progress started. So what it essentially does is set out the conditions that are laid out in your funding agreement in a little bit more detail. Making it clear what an academy can and can't do and at what stages a prior approval is needed from the ESFA. It's relevant to all stakeholders within the academy sector, but most notably members, trustees, whether it's trustees of the main board or local governing bodies, the accounting officer, chief finance officer or bursars, and governance professionals, auditors, accountants, lawyers alike. It's clearly a document that is important to us all. Each year, before getting into the nitty-gritty of the handbook, there is a summary or a foreword put together by whoever at that point is essentially heading up the DFE or overseeing the DFE. This year it's Baroness Barron. Within her summary, she reiterates the importance of financial planning, management and governance within the academy sector. She also notes some of the headwinds that all entities, whether not-for-profit or in the corporate world, are facing at the moment, and most notably inflation, which I'm sure all academies are feeling across the board. She also mentioned the recovery of lost learning, most notably due to COVID and the couple of years that where there was some time spent away from the classroom. She also mentions the priority of growing strong trust. She emphasises how important the academisation of schools is and how high it is up the government agenda. Clearly, we now have a new government, and Liz Truss, we'll wait to see what her view is, but I think the general consensus is the move towards academisation will continue, and certainly a U-turn doesn't seem to be on the cards as we currently speak. I think, as I've already mentioned, not too many changes from the handbook this year. Within her summary, I thought it was interesting. She made quite a bold statement there, which I will just read to you now. Trusts continue to enjoy the right level of day-to-day autonomy. I think that's quite arguable. I think perhaps to have some participation early on in the webinar, it'd be useful perhaps to raise a poll to see what you all feel. Is there the right level of autonomy within the academy sector? So just reading the question there, Baroness Barron mentions that trusts continue to enjoy the right level of day-to-day autonomy. Do you, and there's three choices here, agree, disagree, or it depends? So I'll just leave it for a few moments and then we can close our poll and I can announce the results. It depends. Interesting, and I can see why stakeholders in schools would come to that conclusion. I think in some areas there's clearly the right level of autonomy. In other areas, it does feel year on year that legislation and guidance is increasing, and will it ever stop? But interesting straw poll to see what people feel is the right level of autonomy. So an overview before we get into the detail. As I've already mentioned, it covers off the governance and financial responsibilities. It goes through when ESFA needs approval. It also goes through areas of the funding agreement that you must comply with, and sets out when the ESFA can intervene. Not anything particularly new there from an overview point of view. The Academy Trust continues down the must and should route. There are a number of areas where there is a must, which I think is pretty clear, it's a requirement, and failure to comply with it would be a breach of the handbook and your funding agreement. They are listed out quite handily in part 8 of the handbook, so if you do need a refresher, please do refer to that section. There are also a number of places throughout the document where it's referred to as a should. My view on should is that you probably should be following it. It's the minimum good practice level and is certainly encouraged by the ESFA. Perhaps slightly below the must threshold, but still something as a trust I think you should be following. The Academy Trust is split into 9 parts, much like it has been for a couple of years now. We're certainly in a steady state with the Trust Handbook, and it doesn't seem to be changing very much, albeit a few additions year on year. So I won't go into those line by line. So what has changed? Well, one of the areas where we have seen a change is in the budget forecast return. Certainly a slimmed down requirement. You're now required to produce an annual budget forecast in July, and that moves away from the BFRO, the outturn, and the 3-year forecast returns that were previously requested. I know academies are now complying with this already, so the handbook is essentially catching up with previous guidance that has been released from the ESFA. Another change is around special payments and clarifying when prior approval is needed. So a special payment would be severance pay that's made that's non-contractual or non-statutory. And please don't confuse this with the disclosure in the accounts. This is about when you need prior approval from the ESFA. And the 2 thresholds that you do need to comply with is when the payment is over 100,000, sorry, or their total remuneration is over 150,000. So quite a high threshold there for when you do need to report or gain prior approval. Next slide, please. Thank you. So that covers off the main changes within the financial handbook. More from me in a little while, but I will now hand over to Becky, who will cover off the Academy's accounts direction and the changes that have come up in the latest version.
Thanks, Darren. So yeah, looking at the accounts direction, I'm pleased to let you know that there's very little change in the current year. As a recap, the accounts direction covers periods ending 31st of August 2022 and provides the details for preparing the financial statements. As per the prior year, the ESFA has kept to the 3-document approach, which includes the accounts direction, the Coketown model set of accounts, and the framework and guide for external auditors and reporting accountants, which still they haven't found a more condensed name for that one. They have also been known to publish supplementary bulletins after the release of the accounts direction, but they have noted that they don't intend to do this year, but it is worth keeping an eye on the website just in case they change their minds, because it does come out quite late in the day when they decide to do it. And then just to note that the financial statements are still prepared using a mixture of both standards and regulations, and some of them have been noted on the slide. Next slide, please, Lizzie. So we've just noted an overview of kind of what has changed, but I was going to delve straight into the details. So if you wouldn't mind moving to the next slide. So what are the ESFA saying? So there's still this underlying feedback that they are noting that they want trusts to ensure the financial statements are adequately reflecting the actual performance, i.e. kind of giving a true story on activities undertaken within the year. And this includes both successes, but not kind of failing to admit kind of any adverse results in the year, which some trusts have been noted to do. And they have also commented that only limited wording from the accounts model should be used when completing the financial statements. They are still seeing that a lot of academies are kind of doing a cut and copy from the accounts direction. And in some instances, the wording they are cutting and copying into the accounts are either not relevant to the trust or not specific enough. The next slide, please. And then, so the AAD lists several areas which have been noted on the slide where they have identified that trusts are omitting important information. This is namely around the governance statement and the related party transactions within the notes to the accounts. As already mentioned, a lot of this is because of generic cut and copies, but also driven from trusts reusing wording from the prior year, which is no longer relevant. Therefore, just as kind of a reminder, the whole document should be reviewed annually and compared against the Copetown model, just to make sure all of the disclosures are relevant and trusts consider it to be sufficient. Next slide, please. So what has actually changed? So the ESFA hasn't highlighted a significant amount of changes within the trustees report, with the only real item highlighted is around the organisational structure. So trusts are now required to comment on the structure where the trust as a whole includes either a subsidiary, a joint venture, or associates. And the type of detail they're now looking for includes reference to each subsidiary, including a full name, a company or a charity number, if applicable. And they also want to know the level of ownership and control over said entities. So if they're not 100% owned, they are looking for the percentage holdings. Next slide, please. So within the governance section, the ESFA have highlighted for disclosure of conflicts of interest, and they have now confirmed that academies must disclose information on these conflicts. They do provide guidance and a bit of narrative of what they want included within the accounts. And this kind of notes that trusts must describe the processes and systems in place to not only identify but manage these conflicts when they arise. And this should also now extend to any subsidiaries, joint ventures and associates. Within the accounts direction, they also provide reference to the Charities Commission, where they have noted more detail around conflicts of interest. Next slide, please. So what has changed within the staff notes? So they've made more detailed reference to severance payments. This is because of in May 21, the Treasury issued an updated guidance on severance payments for government funded bodies and have now flowed this into the accounts direction. So they are now wanting these payments to be set out in a banding structure, but the recipients of these severance payments will still get to remain anonymous unless they're in relation to trustees. This doesn't differ hugely from the prior year, but kind of moves away from the more narrative-based approach that we previously had, where trusts had to show not only the total amount of severance in the year, but also kind of each of the individual payments. Let's move on, please. Thank you. Building construction, the DfE is currently undertaking 2 capital projects, being the free school and the priority school building programme, one of which looks at brand new school sites, and the other is kind of major refurbishment / rebuild of current premises in place. Under both of the schemes, the DFE covers the construction costs. And then during this phase where the DFE is retaining kind of control of these construction projects until they finish, then the school should not be recognising any assets on the balance sheet at that point. However, that is with a slight caveat, because they are seeing that some schools are wanting extra assets being put in, which is not kind of under the minimum specification requirements that the DFE usually include within these programs. And therefore, these additional costs that are covered by the school should be included on the balance sheet as assets under construction. And then when the project is completed, the DFE will then kind of hand over the completion and then also the recognition of the land and buildings to the school, at which point they can be recognised on the school balance sheet. It's also important to know that the schools should try to get the valuation reports from the DFE to firstly ensure that the correct amounts are being shown on the balance sheet, but also where the assets kind of contain both land and building elements, it's important that that is split out for the accounts. The next slide, please. Oh, sorry, and the next one. And then moving on to business rates, this came into effect from the 1st of April 22, and there's just a whole new process around the underlying transactions between the billing authorities and the ESFA. So the billing authorities can now opt into this new process. And the new process will mean that the academies no longer have to pay over to the billing authority, the kind of like their business rates bill. Instead, they will send this directly to the ESFA. In effect, the ESFA will be covering all of these costs on behalf of the academy. But it is also worth noting that even though the ESFA will be covering these costs, the schools still retain the liability for these bills and therefore needs to still be reflected in the financial statements. And then the ESFA has specified they wanted this to be recognised by way of grossing up your GAG for the amount of the rates bill, but then just showing the corresponding expense in your expenditure lines. This isn't applicable to all billing authorities, so it's just the ones that have opted into the scheme. The ones that have decided not to will continue as normal of how it previously has been done. The next slide, please. So moving on to changes in submissions for dormant accounts. The ESFA has confirmed that academies which are deemed to be dormant now no longer need to submit accounts to the ESFA in line with the December deadlines. However, just a reminder, there still was statutory requirements to submit these to Companies House by the 31st of May, so that shouldn't be missed. And finally, it's just around teaching schools. So where trusts deliver these activities outside its core, such as a trading school, they must determine if it's kind of included within the trust as a whole, or if it's a separate legal entity. If the trading school is considered not to be a separate legal entity, there's no longer a need to prepare the separate trading accounts at the end of the financial statements. However, if the transactions are material to this trust, whether it be the cost or revenue element, they should still be shown on the face of the SOFA and the notes to the accounts. I think that's pretty much everything from me. Back over to you, Darren. You're on mute.
Someone always does it. Thank you, Becky. Okay, so just to finish off on the accounts direction, I thought it would be useful to cover off some of the comments that the ESFA have made around common themes and statistics within the industry. First one picking up there is qualified audit reports. Within the accounts direction, they comment on 2019 year end and 2020. You can see there that the percentages are pretty low. Some recent commentary coming out of the ESFA shows that the 2021 year end was also very low and certainly below 1% again. So overall, quite a low level of qualification. The main qualified audit reports come from incorrect accounting for land and buildings or inadequate accounting records. For example, certain items cannot be verified and so on. Another area that commonly comes up is pension liabilities and inaccurate pension liability figures within the accounts. Moving now to the regularity audit report, again, the ESFA have released some figures within the accounts direction. You can see there that both in the year end 2019 and the year end 2020, regularity audit reports being qualified about the same amount. Again, we've had some recent ESFA commentary, which states that the regularity audit qualifications has reduced. They didn't give us a figure, but my gut feel is it will stay somewhere around the same sort of level. Main reasons for qualifications that come up is management accounts not being produced or shared. Please do remember that a year or two ago, the rules around management accounts being shared with the chair and also the main body became much more prescribed, and it's something certainly you should be following. Concerns around value for money and lack of payroll authorizations and payment authorizations. So again, it's not really complying with your financial procedures manual. Also not an update in the information at schools to ensure that all appointments and resignations and so on have been properly lodged. Related party transactions, as we're all aware, continues to be a focus for the ESFA. A number of years ago, they brought in rules around prior approval and cost policies. We're still seeing on occasion schools perhaps forgetting or not complying with these rules, and these are clearly areas where you would lead to a qualification of your regularity audit report. So I think that brings us to the close of our main section. Just a reminder of where you can find additional information. We talked about the Trust Handbook, we talked about the accounts direction. Other areas is good practice guides that the ESFA released. There's some useful information in there. And regular letters to accounting officers also give you an idea of the ESFA's direction of travel, which I think is always a useful point to pick up. So thank you very much for joining us here today. I'm aware we've moved through that at a fair speed, so if you do have any questions or anything you would like us to clarify, please do let us know. You can either contact myself or Becky or speak to your usual contact at James Cooper Preston. We haven't had too many questions come through. As I say, we will deal with most of those after the call. One that I thought might be useful picking up as a group is, I mentioned there the direction of travel of the ESFA, and I think that has led to a question around the automation of the AAR, the annual accounts return. I think it's pretty clear all the commentary coming out of the ESFA is that they would like to move towards automation. They would like to move towards accounting software, producing the main body of the accounts return, and also in the future, the financial statements. I think that's clearly the ESFA's intention and where they want to get to. I think there will be a lot of hurdles to get over along the way. I'm not yet convinced myself that the software companies will be ready to populate what is a 50-page, sometimes 60-page set of financial statements. So I think that's still quite a long way off. The accounts return, perhaps, but there will need to be careful consideration to make sure the mapping between what's in the accounts and what's in your accounting software absolutely match. Because if they don't, you'll be giving inconsistent figures in terms of what goes into each box. And one of the main sign-offs in the accounts return is, do these agree to your financial statements? So I think there is a gap in the middle that does need bridging there. But as I say, the ESFA are determined to get there. So perhaps it will take a little while. Recent stats that I've seen, about a third of academies are considering using the automated tool this year as part of their accounts return. It'll be interesting to see whether we get to submission, whether that is still a third or whether that number reduces. So I think it's too early to tell yet, but I think certainly the direction of travel is in that direction. Thank you. That's everything I was proposing and going into today. Thank you all for your time, and hopefully you have a great rest of your day. As always, you know where we are if you have any further questions. Thank you.